Hello and good morning. I welcome you to the morning meeting today on Thursday, the 3rd of May 2018. This is Jens Klatt speaking and exclusively presenting this format to you here for JFD Brokers as their global head of research and education. And first of all, just let me have a look here whether the audio is fine. 1 second, please. I have to double check it here on a second screen. I have to update the site. Let me just fine. 1 second, please. Okay. So yeah, seems to be good. And let's have a look at the Fed statement from yesterday. As expected, no big surprises were communicated. The rates were left unchanged. No surprise here. But, and this is the interesting thing, the statement itself read in a very, very interesting way, and especially when looking at equity markets, there was a development which clearly shows that the DAX currently can only potentially hold his level thanks to the weak euro. By the way, in this context, there was some inflation data published several minutes ago, and inflation data which came in below expectation. So 1 second, let me just check where I have this. 1 sec. So I retweeted this here. Was a retweet from Jamie McGeever, and there you can see it here. So Eurozone flash inflation slows unexpectedly to 1.2%, core inflation down to just 0.7. Expected at I think 0.9 if I'm not mistaken. 1 sec. Yes, 0.9. And in fact, that's it's enough said, let's say here. It's hard for the ECB to justify taking its foot off the easing pedal anytime soon with figures like these. And that's a development here which is very interesting in the US too, and here especially around the Fed statement. So I've worked out, or no, I didn't work it out myself, but I've read an article on the Fed statement yesterday already, and I just want to present it to you since it's a very great summary of what happened. Even though it's difficult to explain why the US dollar was capable of gaining some momentum afterwards, so into the close here, nevertheless, it gives us a good chance to see where potential triggers can be found around or now after this Fed statement, because I think it's in fact all in all quite bearish what we've seen here. So you can read already in the headline: FOMC leaves rates unchanged, leans hawkish on inflation, but nevertheless, and this is the thing, dovish on growth. So that's very interesting, and you can see the key highlights here. Rates unchanged, I've already mentioned this. Decisions anonymous. Inflation has moved close to 2% target. Okay, Fed sees inflation running near symmetric, and this is the key word here, goal medium term. And economic outlook modestly downgraded. Well, not sure what to make out of this modestly downward, because it's a fact that they've removed the following sentence from the statement: the economic outlook has strengthened in recent months, which means that they're quite skeptical, I think, about the economic outlook. But let's come back first of all here to this word symmetric. The addition of the symmetric language traditionally has indicated that the Fed is willing to overshoot on the upside with inflation, hence the hawkish tilt on inflation. So they in fact expect the inflation to pick up, and probably pick up well, more aggressively. Not sure if aggressive is the right word here, but pick up significantly, and here then say, okay, even though if we keep on hiking rates, we are willing to see an overshoot in inflation here, which is probably pushing us significantly above our target rate of 2%. And on top of that, what underlines this is that the Fed also removed the line about monitoring inflation developments closely, and so all in all, they expect inflation to pick up. Nevertheless, they are skeptical about the economic growth or the economic outlook of the US economy. So if you want to sum this up, there's a word for this. We call this stagflation. So that means we stagnate in terms of economic growth, and we nevertheless see a pickup in inflation. And this is in fact a very, very difficult environment in which we are currently in, because if the Fed keeps on rising rates or hiking rates, well, what's the result of this is that this probably accelerates the negative outlook for the economy, for the US economy. And the result was obvious. So let's have a look here at the S&P 500. The S&P sold off into the last minutes of trading after an initial bullish spike. Nevertheless, then after reading carefully through the statement, so it was not a live event yesterday, that's something worth mentioning here, we've seen a quite aggressive sell into the daily into the daily close. And now the interesting reaction was in the Euro USD, so which is, by the way, very stable. If you ask me right now, the current development underlines my words from the German version of the morning meeting several minutes ago. So let's say 45 to 60 minutes ago, I held the German version of the morning meeting, and during this I said that I'm quite positive for Euro USD, and that my line in the sand here currently can be found between 120.20 to 120.30. If we make it above that level, I consider this to be bullish, short-term bullish, and I think that there's a good chance that we are potentially probably making it back at least towards 121, probably even higher than that, towards 122 again. And now the interesting thing about this is, let's go down to the 50-minute time frame here. The interesting thing is that initially the bearish reaction in the US dollar, which can be seen here with this green candle in Euro USD then, was sold after the FOMC, and we made new daily lows. That at first glance, this move does make sense, and I think also at second glance it doesn't make sense. But, and this is the interesting thing, now we can see that the market is pushing back to these levels, which were seen here post the statement was released from the FOMC, and it also makes it possible to say, okay, if we now go above 120.20, 120.30 here, this definitely can be considered a positive sign, and then trigger further bullish action here from an intraday perspective, favoring clearly the long side. By the way, this move here in euro below 120 is one potential reason why the DAX was capable of stabilizing at this elevated level after the squeeze yesterday in the morning, and where we didn't follow the US equity markets then into this weak close we've seen yesterday on Wednesday. Well, we've seen some bearish candles here nevertheless, and yes, we made it. I'm not even sure, did we? Yes, we went out of the trading day below 12,800 points, but nevertheless we obviously we saved most of the gains from the morning. And so now the thing is that all in all, I'm, to be honest, very skeptical about the US dollar now. I think euro has some potential to pull back here, and this is something which is not very positive for the outlook for the DAX then, because the DAX, I think the only reason we can stabilize at this elevated level and present ourselves still stable, even though choppy and very unattractive for intraday engagements here, intraday trading engagements, the only reason why we can stabilize here can be found in the euro. Meaning, if the euro now takes on momentum on the upside and makes back some of the losses of the last trading days and weeks, days especially, I think the euro and the strengthening in the euro will naturally result in the DAX seeing some significant selling pressure. And I could imagine then that, I'm not sure whether it will happen today, but in the upcoming days probably, that the DAX will probably at least retest this region here. So in fact, from a technical perspective, on an hourly chart here, we can consider the picture still be bullish. So everything above 12,500 points, some might probably say everything above 12,300 plus minus, should be considered bullish, can be considered bullish, even though I'm very, very skeptical for further potential on the upside based on this fundamental outlook and the statement from the Fed. But on top of that, also very interesting, look at the hourly chart, the daily chart here in the DAX. I mean, We've mentioned this already yesterday. The risk reward on the upside is very, very unattractive because the region around 12,800 to 12,850 points can be considered a quite significant one. It seems to be a strong resistance zone. The lows from November, the lows from December, the lows from January here are all lying in this region. It's a former support region, and after we broke below this level in February, we now find strong resistance in this region here. So from a risk reward perspective, long engagements seem to be very unattractive in my opinion, and I definitely favor short engagements, even though I have to say, when trading the short side, I probably wouldn't trade it very aggressively, since again the overall mode in the DAX seems to be bullish, is bullish, not just it seems, but it's bullish from pure technical standpoint. And so it's not only that I'd reduce the position size here, but it's also true that I'd wait for the DAX to make new intraday lows here, falling below 12,755 before taking any action here on this on the short side, if I take any action at all. Yeah, so that's it on the DAX here. Again, the euro was already covered. The main region I'm looking at right now is here, can be found 2030. This region, if we make it back above that level, next target, and there you can already see it. I mean, the overall picture is still bearish, which means everything below 121.30, 121.40 here shouldn't be taken. Long engagements should be taken with carefulness. First target here, if we make it above that level, is already 20 to 30 pips higher, around 2060 to 2070. Nevertheless, I somehow think there's a good chance that the euro can probably make back some of these losses of the last days. By the way, the same is true for pound sterling here against the US dollar too, probably even more than in the euro. The reason for that is simple. You can see that with this aggressive selling taking place here, and the chances of a rate hike of the Bank of England taking place in May dropped significantly from way over 80% to significantly below 20% now, and it's completely priced out. So now the thing is that the mood somehow seems to be a little oversold here, and a pullback seems likely. A pullback seems around the corner, and definitely something to consider, even though similar to the euro, I'd not think about long engagements below the lows here from the Fed yesterday, which can be found around 36.50 to 36.70 here on the upside. So we need to make it back above this level to consider long engagements. Everything below that should be also taken with carefulness, really, and then we shouldn't be too aggressive here with long engagements, even though from a risk reward perspective I think it's fair to definitely take anti-cyclical long engagements into account here in this region. So that's it in pound sterling. Let's have a look here at dollar Japanese yen. Sure, the thing is that here the picture stays critical. We had short-term bullishness after we made it above 107.50 to 108, yes. Nevertheless, you probably recall some of my quotes from February, March, when I said, well, even if we make it back above this level, I'd be really careful. That was way before we saw this solid bottom forming here, and that was, yeah, it must be somewhere in March, the beginning of March. I said, well, even if we make it back above this level, I consider the picture to be to brighten up if we make it back above 110, 110.50. Everything below that, I'd be very skeptical about long dollar Japanese yen. So again, short term bullish was okay after we broke back above 108. Nevertheless, now the market faces some difficulties around 110, which is no surprise given the statement from the Fed yesterday. And now that the question arises, is it probably worth to give it a try to trade the short side in dollar Japanese yen, to expect probably dollar Japanese yen to at least retest the region of 107.50 to 108? I think the answer is yes. So I definitely take short engagements into account. We can already see that we fall below the Fed lows here. So pullbacks against 109.60 to 109.70 can be taken into account for short-term engagements with a stop above the highs from yesterday, which can be found around 110.05, 110.10 here. And yeah, the target of such an engagement, anti-cyclical short, can be found here around 107.50 to 108. And let's now have a final look at gold, which is definitely worth a look, because yesterday underlines the mid to longer term outlook that there's a high chance that gold will potentially make it above 1,360 to 365 USD per ounce, and sees a quite bullish, or has a quite bullish outlook. So some of you might wonder why this is. Well, this is in fact quite simple. With a diminished outlook for the economic growth in the US and long-term yields to be expected to stabilize around the current level, probably see a slight pullback here, gold becomes definitely more attractive. With the recession forming, definitely attractive, more attractive. And so now the question is, if you want to trade such a break, do you have to wait for a breakout to occur or not? I mean, you know that I'm a friend of anticipating such breaks. And I think with yesterday, we now have a good trigger, potential trigger here, which can be found around the highs from here, from the Fed, 1,314 USD per ounce. So what I take into account is go long with a break above the highs from yesterday. That's the first half you probably bring up here. And then trying to anticipate the break and probably take another half once the break really occurs then here on the upside. So I'm even more positive for gold now after the statement yesterday of the Fed, since it underlines the chances for gold long positions here. And I think the risk reward is also quite attractive, especially for the first half, where you could place your stop below the lows, which were made here on the 1st of May on Tuesday, around 1,301 USD per ounce, 301.70 in fact. Yeah, and so the outlook for gold is definitely quite bullish now with this statement, long term, midterm at least. And again, I definitely consider first tries here in this region, long engagements, first tries to anticipate breaks on the upside to be probably interesting, and from a risk reward perspective, attractive. And that's it. So I wish you all the best. Happy trading. Watch your stops. Talk to you again tomorrow at 9:30 a.m. GMT on Friday. And if you have any questions, please shoot them over via mail, via Twitter. I definitely I appreciate it to answer your questions, and I wish you all the best. Talk to you soon. Take care. See you.